Hi, this is Karen Lin. Welcome to the week 7 of financial accounting course. In this week, I'm going to introduce property, plant, and equipment, which in the future slides I'm going to short form as PP&E. So what is the PP&E? PP&E are resources with useful lives greater than 1 year, and they are used in normal business operations, and they provide future benefits through their physical form. An example of PP&E, let's say it's a machine. A machine obviously will serve the firm for more than 1 year, and they are used in business operations, for example, to produce catch-up, and they provide the firm with benefits through producing catch-up. So machine, land, buildings, those are the assets that are suitable or fit into the definition of PP&E. There are some assets that may not fit into the PP&E framework. For example, a pen, right? A pen may be used for more than 1 year, but it's very small. It's a small asset that is not considered PP&E because we are usually considered assets with a big value and survive for several years for a firm. So a pen, or in our guitar lessons case, if you bought a string, if you bought like a whiteboard pens, those are what we call supplies. Sometimes a supply could survive or serve the firm for many years. For example, if you bought a calculator, but that's not PP&E. So other than these three criteria, basically another criteria we usually judging PP&E is the materiality, which means how material, how important is that asset. Because in this lecture, I'm going to discuss depreciation with you. Some of the assets are too small. It's not worth depreciating. So I'm going to come back to this after I finish this video at the end of this video, and we will see that clearer. Let's take a look at a typical PP&E and their stages. So let's say a firm purchased a truck. Okay, a truck is a PP&E because it's material, it costs a lot, and it would and ended up using with serving the firm for more than 1 year and bringing future benefits to the firm. So we start with a brand new truck, right? We know at the end of the day, this brand new truck is going to go to the scrapyard. So these are the two stages that a truck would have, the brand new truck and sort of like the scrapyard truck. Between these two stages, there are a period of time. So there are a period of time between these two stages. I'm just going to draw a line between this. Okay, so it is a time period between these two. Let's say 5 years. Okay, so from new trucks to the end of. Okay, so there is a time span between these two stages. In this time span is estimated, first of all, based on our experience or in the guidance of the GAAP. So when we estimate this 5 years is an estimation, when we estimate this 5 years, we call it useful life, which means there is a time when we could use the truck to serve the firm. Okay, so there are three things here. First, we have the original cost when we purchase a new truck. Two, we have the end of the day of the truck when we send the truck to the scrapyard. It would probably return with some money, say $5,000. Then that's called salvage value. In between, we're using this truck for a couple years. This is called the useful life. Again, useful life is an estimation. It is an assumption. Now let's take a look at the nature of PP&E. There are two main difficulties that PP&E could present to the management. The first difficulty is that the amounts in those assets could be large. For example, if we take a look at ExxonMobil, The investment in PP&E in 2009 is 57 billion, but in 2019 it's 248 billion. Now look at how much ExxonMobil earned every year. In 2018, ExxonMobil's net income is only 20.8 billion. So you can see PP&E are presenting a huge investment compared to how much net income that ExxonMobil earned during the last year. So it is a huge chunk of money. Again, if you buy a pen, that wouldn't fit into the nature of PP&E because they are too small. Another difficulty is that it is difficult to determine the dollar amount of such assets used up in any one period. So we have to have some assumptions in this lecture that we are going to present. And you need to know all those from this previous chart, all those useful lives, each year's usage, and the salvage value, they are all estimations. So those are large numbers, and it's difficult to estimate from the beginning. So all our estimations could end up with some inaccuracies. So let's talk about determining the value and depreciation of PP&E. So the accounting issues of PP&E includes how are we going to determine the total cost, right? How do we determine the periods in which we are going to recognize the depreciation? I'll talk about depreciation in a minute. And we need to determine the total amount that should be depreciated. We need to determine the amount of the expense. We need to determine the effect when we dispose the PP&E. So all these accounting issues are evolving around the life cycle of PP&E when we first purchase it, when we are using it in between of the purchase and the end of the assets, and then when we dispose the asset either to the scrapyard or sell on a second-hand market. So let's talk about those things one by one. First of all, how do we determine the cost of PP&E? Normally, for an equipment, the costs are all relevant usage of resources to obtain the PP&E and prepare the PP&E for use. Now, this is an example. A firm paid $27,300 for an equipment. It's a display equipment. The equipment, this $27,300 includes the sales price of the equipment, the delivery of the equipment, and the warranty of the equipment. Okay, now you ask yourself, are those all the cost? Are all those items considered the cost of the equipment? Now, going back to what are the cost of the equipment, it should be any cost to prepare the equipment for use. Now you can see sales price, of course, delivery, of course. If you don't have those, you don't have the asset. But the 9-month extended warranty would be something happen after the PP&E is in use. So it is not considered a portion of the total cost. So when we report the cost of the PP&E, it would be the sales price plus the delivery. So that's $27,000. So we would debit the warranties, we would debit the equipment, we would credit accounts payable if we pay on account, or if we pay cash, we'll just credit cash. So that's the first stage. That's when we purchase the PP&E. We have to determine the cost of the PP&E and try to show on our accounts how these items are recorded. Now let's start to talk about the use of the PP&E. PP&E are used in operations. They contribute to the business operations so that we have to recognize the usage of the PP&E. How are we going to recognize them? It is in the form of expenses. Now, do we remember what are the expenses recognition rule? You can pause this video for a second and think about it. The answer is when we recognize expenses, expenses are recognized using the matching principle, which means the amount the asset is being used during this period when revenue is generated, right? It has to be matching the revenue. So to recognize a PP&E, for example, the display equipment we just talked about, $27,000. Here is a little quiz. So if it's the useful life is 6 years, how do you think the depreciation expenses should be reported, right? Which one is correct? 1, only in the year when equipment is purchased. 2, every year when the equipment is being used. 3, only the year when the equipment is sold or disposed. Obviously, the answer is in every year in which the equipment is used. As we said, it's a matching principle. In each year when we use the equipment, we generate revenue. So each year, the usage of the equipment should be recognized as expenses. We call those expenses depreciation expenses. That means we are going to recognize the depreciation or the deteriorating in the physical existence of that asset. Remember the form, the graph I just showed you, when you have a new truck and then when you have the scrapyard truck, there are something happen in between. They don't happen within a day or two, right? So what happened in between? We're using the truck, right? So that is the depreciation process of the truck from the new truck to a wasted truck, basically. So there are two ways that we usually normally do depreciation. Those are all assumptions. The first way is called the straight line depreciation method. The second is called double declining balance or accelerated depreciation method. I'm going to discuss these two methods separately, but the idea again is to determine how much we have been using this asset each single period between the new truck and the wasted truck. Okay, so in reality, most of the firms use straight line depreciation method. 4% using double declining of balance, 5% using units of activity, which means depending the depreciation of the asset depending on how much the firm is using the asset. For example, if you have a machine producing ketchup, the depreciation expense would be determined by how many bottles of ketchup is being produced during that period. So it's kind of more accurate, but it requires more work for the accountants. 8% of firms using other different methods. Okay, so that's the depreciation method choices. Let's talk about straight line. Straight line depreciation assumes that the truck is being used pretty evenly throughout this, say, 6 years, 5 years of the useful life, which means the firm determined that the truck is going to degenerate in physical existence evenly throughout these 6 years. Okay, that in that case, we would recognize depreciation expenses evenly throughout the 6 years of the asset, or evenly throughout the useful life of the assets. Let's go back to our use of the PP&E of our display equipment that cost us $27,000 in the beginning of this lecture. Remember, we have the asset when we purchase it. This is $27,000. I'm going to write it down. Right? And we also assume the salvage value of the equipment is actually $3,000. Okay? That means between these two states, how much equipment can we be possibly use during, of course, the useful life, 6 years. So the useful life and the salvage value are all estimated. Now we have in between the purchase and the disposal for 6 years, how many how much in dollar amount of the truck is the firm going to use during the 6 years? How much is the firm possibly be using? That would be 27,000 minus 3,000, right? Equals to 24,000. Can you see this? So you purchase a truck, $27,000. When you send it to the scrapyard, it's $3,000. So how much are you possibly be using during the 6 years? That's the difference between the two. That's 24,000. Okay, so this is very important. I'm going to save this. This is very important because we need to know how much has been using during this 6 years. All right, so from my previous illustration, now we know how much we should be depreciating of the asset. It would be the cost of the acquisition, 27,000, minus the 3,000 of salvage value, or sometimes it's called residual value. That the difference between the two would be the total cost that we are going to depreciate. So that's the difference between these two. That is going to be depreciating in 6 years, right? So the formula to calculate straight line depreciation expense would be the cost minus residual value divided by the useful life, which means over the 6 years, if we use this asset evenly throughout the 6 years, how much are we going to use up each year? That would be 24,000 divided by 6 years, 4,000 per year. So you could see the depreciation schedule would look like this. Every year, the firm is using up $4,000 of the asset. At the end of the day, it's totally using up 24,000 of the asset. Year one, we are going to debit depreciation expense. This is an expense account because we are using up the machine. So, or the equipment, the display equipment. So we are debiting expenses. We are crediting. This is a new account that we never seen before. It's called accumulated depreciation. What is this account, or what does this account mean? Is that it is a depreciation, but it is accumulated throughout the overall 6 years of the equipment. Okay, so again, this is the expense. The debit side is an expense. The credit side is basically like a accounting device to count how much depreciation the firm has been used up so far. Okay. On the balance sheet of a firm, we will see that the equipment's cost is $27,000 in the first year. This number will never change. So during the first year of the purchase until the end of the equipment, it would always be showing 27,000 for the equipment. This is called historical cost of the equipment. The investors or the outsiders wants to know how much we get the equipment for, so we keep showing the original cost of the equipment for the investors. Now we will be subtracting what we have just recorded a moment ago, accumulated depreciation 4,000. So that would be the accumulated depreciation subtracting from the original price. It would also show the investor how much equipment has been left so far. That's $23,000 of the equipment. We call this accumulated depreciation account, which is in the balance sheet. We call it contra asset account. A contra asset account is kind of an asset account because it's in the asset section of the balance sheet, but it is considered contra means opposite. So it's the opposite side of the asset account. So it's a negative. You can consider it as a negative asset. So it's a opposite of our asset account. So it works like in a negative way. Okay. In the income statement, we will be including this 4,000. Okay. So now let's assume year two. In year two, you would be making the same entries again. So it says year one depreciation. You should change it to year two. But you are doing the same debit and credit. We are still debiting depreciation expense 4,000, crediting accumulated depreciation 4,000. Now remember, all those expenses accounts, they are temporary accounts. Remember chapter 5? So they all closed. And accumulated depreciation account, because it's an asset account, although it's a sort of like a negative asset, we are not going to close them. So this is not closed. Every year we are adding up to the depreciation. So the second year you will see that the accumulated depreciation becomes 8,000. The first year 4,000, second year will become 8,000. And the remaining equipment will be 19,000 again. Okay, so that would be how much it's worth of the equipment on the date of December 31st of the second year. In the income statement, because previous year's depreciation expense has been closed, you cannot report 8,000 in the income statement for second year. You are still reporting 4,000 in the income statement. So if we look at all 6 years, every year the asset decreases by 4,000. This can be seen here. The first year it decreases by 4,000. The second year it decreases by another 4,000, right? 23 minus 19, that's 4. So every single year it decreases by 4,000. At the end of the day, overall it decreases by 24,000, which means the remaining value will be 3,000. Okay. The original cost minus the 24,000 depreciation, that is the 3,000, which is exactly the remaining value. So this tells us, or this explains why when we started to calculate the straight line depreciation expense, we need to exclude the salvage value at the beginning. Remember the formula? We need to exclude that in the beginning. And at the end of the day, sources of resources are decreasing 4,000 each year. Those are depreciation expenses, which decreases retained earnings by 4,000 each year. Okay, so the general ledger would look like this. Would look like we have a display equipment, which is the historical cost of equipment. It never changed, as I said, during the 6 years. The accumulated depreciation expense would be increased by 4,000 per year, and this is not a temporary account, it's a permanent account, so it never closes. So it's 24,000 in total for the 6 years. The difference between these two would be the residual value. The depreciation expense, every year we debit expense, but then we close them out. So we debit expense, credit accumulated depreciation. At the end of the year, we have to close it out. You would be crediting the expense, debiting income summary, right? Remember? So we are closing it out. It goes to 0. All right, I'm going to stop here for this video, and in the next video, I'm going to discuss accelerating depreciation with you. See you next video.